Alright everyone, Cowboy Trades here. Welcome back to the channel and welcome to the educational series. In this episode, I'm going to be running you through one of my favorite liquidity tools in order to quantify liquidity in the market during both bullish situations and also bearish situations. I'll be letting you know how I use the Chicago Mercantile Exchange liquidity tool to successfully navigate a bull market and also how to successfully navigate a bear market. Let's start off with the fundamentals though. So we're going to head over to the CME group. I'll leave the link to this resource down below so you can use it yourself. And what we're going to be looking at and focusing on today is the book depth for the E-mini futures and the S&P 500. That might sound like a mouthful, but let me run through the fundamentals. It's actually very, very simple. So what we're looking at, these are the E-mini futures for the S&P 500. So basically we're looking at the futures for the S&P 500, and more simply, we're looking at liquidity in the S&P 500. Now, what is the book depth? The book depth is simply the number of contracts. As you can see over here, the quantity is on the left side. It is the number of contracts in buy orders and also sell orders at a given price. Now, we have the mid price over on the right side of the screen, and you can also see this blue line that we can remove or add back on. I highly recommend that you do keep this on the screen because during a bull market, you can very much see when there's higher lows forming, and then that is a good sign for an entry. And opposingly, if you're in a bear market, which we'll look at in a second, looking at volume over extensions and shorting them is also a perfect way to navigate the market. But let's start off in a bullish market situation. We're going to be looking at a 1 year time period between the dates of the 11th of December 2020 all the way up to the 11th of December 2021. And as you can see, this was when the S&P 500 was in a bull market. Now, you can see over here, I've highlighted with some vertical rays these green bars, and you can very much clearly see that these correlate to some dips, and if you were buying when these dips were taking place, you would have definitely made some gains on that. Now, how would you have known that this was the absolute dip and we were going to start moving to the upside? Well, let's head over to the book depth and let's look at the book depth for the E-mini futures and the S&P 500 at the time. Now, one thing to note is when you are in a bull market, the quantity of buys and sells is much more prominent than the bear market. So for example, you can see contracts range between 150 and 200, and to the downside 100 and 150 captures the majority of them. But when you come over to a bear market, you can see liquidity conditions are dampened and they're only round about 80 sizes in contracts either way. Now, like I said, let's focus on a bullish market situation to start with. Now, it's probably easier to look at the dips on the weekly, but you can very much but you can click through this. You can look at how the liquidity moves day to day, week to week, month to month, quarter over quarter, or yearly. I really only like to look at daily and weekly. But if we start off on the daily, you can see right here, there was a dip, right here, there was a dip, and right here, there was a dip. Now, when you're looking at these dips, it's very, very easy to see as soon as liquidity comes down to these heartline levels, as soon as the mid price starts to have that reversion to the mean, it tends to snap back up to the upside when there is excess liquidity in the markets. And as we know, if you do watch the channel, you'll know that excess liquidity is what causes bull markets, which is why when you're looking at liquidity tools in a bull market, there's far more quantities of buy and sell orders at this moment in time. So you can see dip here, and dip here. Let's place them over the E-mini futures chart, and you can see this is where the dip lines up in the liquidity conditions, this is where the dip lines up in the liquidity conditions, and this is where another dip lines up in the liquidity conditions. Now, you can take a few of the smaller ones here and there. I just wanted to highlight the macro ones just so you can see, but once again, when liquidity conditions reset to their mid-price trend line, as you can see, low here, higher low, higher low, higher low, higher low. If you're in a bull market, it's normally a good time to buy, and hence when you are looking at this bullish market situation in the S&P 500, you could see if you were just looking at the CME liquidity tool and saying, hey, the book depth is coming down to pretty low levels, contract sizes are pretty small at this moment in time, there's not a ton of interest in the markets, liquidity conditions are dampened compared to how they've been in the previous weeks or so, that's normally a good time to enter the markets. And as you can see, that is very much the case. The CME tool is a very, very simple and powerful tool to understand in the markets. Now, you can dive through a ton of these. They're over on the CME group, which once again I will link down below. You can look at liquidity in Bitcoin futures. You can look at basically almost anything that you would really want to look at liquidity conditions for. You can look at the book depth, you can look at the bid-ask spread and the cost of trade, or you can compare these with different indicators. I personally think if you just stick with the book depth, you will probably be just fine. So once again, looking at the bullish market situation, looking at the CME liquidity tool, this would have definitely helped you navigate a bullish market situation. Now, How will this help you in a bear market? Well, let's look at how the CME liquidity tool acts when you are in a bearish situation. So once again, you can see the quantity has gone from, 150 to potentially up to 200 contracts, all the way down to, price ranging between 60 and 80 contracts. And this makes sense. Price is breaking to the downside, liquidity conditions are dampering, and that's how liquidity conditions are small. There are small contracts in the markets. There's not many buyers and sells. Mid price is heading to the downside. That's when you know that price is going to continue moving to the downside. So when we come over to here and we look at the daily time frame, you can see there is a peak right over here, December 30th. You can see there's a peak over here, March the 30th. You can see peak over here, August the 15th, and you can see quite recently, over on December the 1st of 2022, we also topped out in the mid price. So once again, this is why I highly recommend that you place the mid price over this. If you're not placing the mid price over this and you're only looking at the contract sizes and not the mid price, it's definitely harder to see, when these peaks and troughs are going to come into the market. So once again, definitely make sure you're using the mid price when you're using this. But once again, it's almost the inverse of the other chart. With this, you're really looking out for, in a bullish scenario, you're looking out for higher highs, you're looking for higher lows rather. So higher lows, higher lows, higher lows, higher lows, and that's a good place to enter a trade. But in a bear market, liquidity is dampened, contract sizes are much smaller. You can see if you're shorting these volume overextensions, when tons of contracts start to run into the market, shorting from this area and this area and this area is very good. And you can basically, draw a trend line in your head and you can see, boom, you're basically on a very, very steep run to the downside. So when we place these volume overextensions here, remember, we just talked about the top here and here and here and here. All I've done is on the exact date that this tops out in the liquidity conditions, on the weekly time frame, I've gone, hey, it tops out here, hey, it topped out here, hey, it topped out here. I just placed this vertical line over the chart, and you can see when in a bear market and liquidity conditions and the mid price is heading to the downside, you can see what does this liquidity top correlate to? It correlates to a top in price action. What does this liquidity top correlate to? It tops to this top in price action. What does this liquidity top correlate to? It tops to this top in price action. And quite recently, you can see we've also topped out once again, and this is another top in price action. So whether you're using this in a bear market and you're looking at, hey, volume is very overextended right now, I should probably be shorting, you can see how much of a powerful indicator this is and how it will help you navigate the markets. And opposingly, if you're in a bull market, it can do the exact same thing. You'll see contract sizes expanding. You'll see the quantity of buys and sells increasing. You'll see the mid price constantly make higher lows. And when these higher lows start to formulate themselves, they're often presented with a big drain in liquidity. And in a bull market, it is very, very interesting and very, very easy to navigate these markets. If you're just looking at the liquidity tools, worrying about liquidity in the markets and saying, hey, when liquidity conditions once again come down and dampen to the mid price, dampen to the mid price, dampen to the mid price, break down to the mid price, break down to the mid price, that's probably the time that you want to start entering your next trade. So once again, you can use this for the E-mini futures, and you can also use this for Bitcoin because, obviously my channel is a Bitcoin centric channel. So like I said, you can use this for a plethora of different things. My favorite thing to use this for though is the E-mini S&P 500 futures. Once again, you can change the dates over here. I personally recommend, like for example, at this moment in time, I am in a bear market. As of the time of recording this, we're in a bear market, and what I'm doing is I'm looking at this on a year-to-date schedule, so from December the 11th to December the 11th, and I definitely think this is the best way that you can possibly navigate these markets by purely focusing on liquidity. So that's all I've got for you for this educational update, my friends. As always, if you do enjoy the content, make sure to let me know down below by leaving a like, comment, share the videos with your friends. But anyway, that's all I've got for you for this episode. Cowboy out. Peace.